Gordon growth model, part 2. So now we want to look at how to use the Gordon growth model to estimate fair value. What is reasonable, right? Using mathematics. Well, here's our basic valuation formula. We have the price of the stock equals to the future cash flow discounted by a certain discount rate. If the cash flow are in the form of dividend payment, then we can simplify this equation as the value or price of stock equals to the sum of future dividend discounted at a certain discount rate, R. And if dividend is growing at a certain rate, let's call G percent, then we can simplify this even further by having the dividend T equals to dividend of the first of the current year multiplied by 1 plus G. Then in the second period, the current dividend multiplied by 1 plus G to the power of 2, and so on. This presents a challenge because we can recognize that G is growing, the dividend over time, but this takes us all the way to N, to infinity, right? We don't have enough time to calculate to infinity. Fortunately, this equation can be simplified into D0 multiplied by 1 plus G divided by R minus G. Okay? So G can be estimated from the last 5-year dividend. We can plug this in here. And when we do this, then we have to make the assumption that we think that the future looks like the past. If the last 5 years dividend is growing at G, then we expect the next 5 years and beyond the dividend to grow also at G percentage. And R obviously would refer to the current discount rate. Okay? So let's put this together. And if we were to go to gurufocus.com, we can see the dividend payout ratio at 0.47. We can look at the dividend yield at 3.67 trailing basis, meaning the last 12 months. And the expectation in the market is that on a forward basis, looking into the next 12 months, the dividend yield is also 3.67. Okay? And here we have the dividend growth rate for the last 5 years at 16.4%, right? And the share buyback ratio at 4.7%. Okay? So when we put this together, right, we can also try to think about the historical range of the dividend yield, seeing that where we are here is at the lower end of its historical range. And if we look at the growth rate over the last 10 years, it was a lot higher compared to the last 5 years and so on. Okay. So this gives us a very good estimate on what is reasonable when we put in the numbers. It's quite easy to calculate the Gordon growth model estimate for the stock value. If we have our next year dividend at 2.1% and the discount rate 8%, annual growth rate at 5%, using a simple Excel, or we go to this website for our research, it will come out as $70 given this assumption. Right? What if we were to say that suppose the discount rate is not 8%, it is 7%, then a simple calculation by changing the discount rate here, it tells us that the Gordon Growth model estimate for fair value is now $105 instead of $70, right? So it provides the framework for us to put in the numbers. So this allows us to think about sensitivity analysis. Okay? Just now I've shown you how we can change the 8% to 7%, but really, what would make us think about reducing the discount rate from 8 to 7? In the first place, why 8 before we reduce it to 7, right? This create a lot of complication because of all the variables in this formula. What we know for sure is the price today that's being traded in the market. We can estimate this with a reasonable justification by looking at the last 5 years. And the current value of dividend is a number that we can take from the company's reported statement, right? So given what we can reasonably input, we can reverse engineer this equation to find out what is the market implied discount rate, rather than coming up with our own estimate for discount rate to calculate a fair value for the stock, right? So we are doing this the other way around, right? Instead of forecasting the fair value, we say, given this price, given this, what is the market expecting for the discount rate? And does that discount rate look reasonable? Is it too high? Is it too low? Because if it's too high, then the price is too low, right? Because if we think that the environment should not be that pessimistic, this gives us a way to value this. Let me illustrate. Right? Given the value or the price of stock and the current dividend and the dividend growth rate, we can find the current implied discount rate. Here, I'm using the data from StockTrack and Microsoft. We click on the key ratio, we get our dividend. So we have enough data. We have our our price of the stock. We have our dividend growth for the last 5 years at 10.92. And we have our current dividend at $2.04, right? So we have our V 137.73, our D0 is 2.04, and G 10.92, right? So we have V equals to D1 divided by R minus G. V, the stock price, $137.73. And D1 is now 2.26. Why? Because D1, right, is D0 multiplied by 1 plus G, right? And then we divided this by R minus G, we know it's 10.92. When we reverse this over here and this over here, we have R minus 0.1092 equals to 2.26 divided by 137.73. We bring this over here. So R equals to the answer here. We bring it over here, we add it, we get 0.1256, right? 12.56%, right? So using a simple Excel spreadsheet, we put in this formula and the numbers. We get our required rate of return, implied return as 12.56, right? The implied discount rate at 12.56. And from this, we can then create a very simple sensitivity table, right? So notice that in the center here, I have the stock price at 137.80 cents, which is where we are seeing it today. And we plug in the G, the constant growth rate for the dividend at 10.92, where we plug it from here and that website just now. And when we plug in this number, right, it gives us the required discount rate as 12.56, which we have calculated here, right? With this, we can very easily create a sensitivity table by minus 0.5%, add 0.5%. Over here, minus 0.5, add 0.5, right? So when we reverse engineer, we have this and this, we can now calculate this, right? And we have this and this, we can calculate this, right? So under what condition can Microsoft share double in price? Well, this sensitivity table can help us a lot because we can see that from $137.80, it can become $353.13 if the dividend growth rate were to increase from 10.92 by 0.5% more to 11.42, and that the required rate of return, the discount rate, dropped by 0.5%. Okay, so we look at this and we say, well, this is reasonable because Microsoft has a lot of cash flow, and they may want to decide to pay 0.5% more, right? At the same time, if we think that the economy is going to be fine, we don't have any serious inflation threat, and the market is turning more optimistic, allowing the discount rate to drop slightly, then we'll say that it is possible that we have this best of both worlds to give us a stock price of $353.13, right? If somebody say that that Microsoft share can go up to $600, right? Then we would have to enlarge our sensitivity table and see under what condition. Maybe $600 would require a lot more good news in the sense that we may need to see a bigger jump in the dividend growth rate and a bigger drop in the discount rate, okay, which could be a lot less likely. It's also very useful when we are faced with an uncomfortable situation where the stock price is down suddenly by, say, 40%. What should we do? Well, having a table like this would help to calm us down and reduce the emotion in our decision-making process. Because if it's down by 40%, let's say it is down trading around $85, we bring out our sensitivity table and we see that, well, at this price, the market is discounting an increase in the discount rate by 0.5%. Stock market sells off, the market is now very confused, they are more conservative, and the discount rate all goes up. So we might say, well, it's reasonable, right? We cannot challenge this. The market is in a very fearful mode, right? So we may leave that alone, and then we look at this as this variable here. At $85, it is discounting that the Microsoft would reduce the dividend growth rate by 0.5% to 10.42. Well, we know that Microsoft has a very large cash flow, and we know that this is more like a consumer staples in the sense that although it's a technology stock, but whether it is the economy doing well or in the recession, we still all have to run our computers, and we still need to use the Microsoft software. right? So given the very strong financial flow, the cash flow, we could say that, well, I disagree with the market, expecting the dividend growth rate to be cut by 0.5%. I think more likely it will stay at 10.92, while we accept that the discount rate could go up. So in that case, feeling very confidently that G will remain at 10.92, then we think that the market fair value should be $105.61. So at the minimum, this table would calm us down and prevent us from selling our Microsoft shares. In fact, it might make us want to buy more of the Microsoft share, expecting the market to trade up from $85 to $105 as the market settle down and go through the same decision-making process as we have done. The Gordon Growth Model sensitivity table can be improved further, right? Because for the G and R, instead of adding or subtracting 0.5 in a very mechanical manner, we can use the recent high low. We can use the last 10-year highest level for G or R and the lowest level. For the yield, instead of just looking at dividend yield, we may want to take into consideration the net buyback yield and use the total yield instead, right? So this would be some enhancement if we want to do a higher level of research for the stocks. So Gordon Growth Model, right? In conclusion, we can only use this for dividend paying companies and apply to companies that are insensitive to business cycle, because we want to look at companies that would be paying the same dividend or with an increase over the time period. Right? We cannot apply this if the company pay high dividend when times are good and then cut dividend when times are bad. Right? This kind of cycle is not applicable for the Gordon Growth Model. And typically, we look at companies that are at the mature growth phase, because they typically are the one that are insensitive to business cycle and typically have a lot of positive cash flow into the company.